Ladies and gentlemen, esteemed financial enthusiasts, and those simply curious about the wizardry behind the curtains of corporate accounting, arm yourselves with your most cynical spectacles and prepare for a journey into the heart of fiscal prestidigitation. Today, we dissect the magnum opus of financial forensics, Financial Shenanigans by Howard Schilit, a veritable grimoire that reveals how companies magically make troublesome financial troubles disappear or, inversely, conjure profits out of thin air. Let's embark on this enlightening excavation together and unearth the top 10 insights that Schilit deftly brings to light, ensuring you're equipped to spot those crafty ledger domains that mask the true performance of businesses. 1. The art of earnings manipulation. Schilit starts with the bread and butter of financial shenanigans, the manipulation of earnings. This sleight of hand is as old as double-entry bookkeeping itself. Businesses can smooth earnings, pulling profits from the future into the present, or push present expenses into the nebulous later, ensuring the now looks particularly rosy. This is like that friend who borrows money from you to pay for dinner today, promising to skip dessert tomorrow. A charming notion, but when tomorrow never seems to come, your wallets, much like your patience, may find themselves permanently lighter. 2. The cash flow conundrum. It's often proclaimed by the financial sages that cash is king and that the statement of cash flows is immune to the charlatan's touch. Yet Schilit exposes the chicanery hidden in plain sight. Cash from operations can be inflated by selling off prized possessions, quite literally the family silver, or by delaying payments to suppliers, much like how a child hides their peas under the mashed potato. The plate appears clean, but the peas of truth remain. 3. The balance sheet balancing act. Schilit takes us to the balance sheet, which he argues can be as balanced as a seesaw with an elephant on one side and a mouse on the other. Companies might inflate assets by grossly overestimating the value of inventory or intangibles. Likewise, they can deflate liabilities by failing to recognize or disclose significant obligations. The result? A facade of financial fortitude that could crumble at the slightest prod of due diligence. 4. The big bath buffoonery. Ever heard of taking a big bath? In corporate terms, this doesn't involve bubbles or aromatherapy candles, but rather an unpleasant dive into one-time charges. When a company has a bad year, they might as well make it look horrendous, pile up all conceivable losses and write-downs. Thus, future years are cleansed of these blemishes, their financial complexion looking unfairly unblemished. 5. The revenue recognition ruse. The timing and recognition of revenue are yet another stage for corporate trickery, a sort of revenue, now you see it, now you don't. Schilit uncovers the guile in recognizing revenue too soon, or even fabricating it, selling to the proverbial customer who has no intention of paying, like making lemonade sales to a gathering of sour-faced lemons. 6. The acquisition mischief. Acquisitions, often seen as a symbol of a company's growth and aggression in the market, can just be a ruse for entrenching more shenanigans skullduggery. Through the murky waters of pooling of interests accounting, or by pushing acquisition-related costs into operational ones, businesses can turn a mediocre year into an apparently stellar one, an accountant's equivalent of putting lipstick on a pig. 7. Creative cost capitalization. Next, Schilit addresses the almost artful way companies convert what should be considered normal operating expenses into capital expenditures. This makes profit and loss statements look better, while future periods unfairly shoulder these costs. It is much like choosing to bake a decadent, highly expensive chocolate cake and then spreading the cost over the next decade of grocery bills. Delightful for the first slice, but increasingly hard to digest over time. 8. The cookie jar reserves. Remember hiding cookies in a jar for a rainy day? Corporations do the same with reserves. They might overestimate the reserves needed during good times, stashing profits away to prop up results during leaner periods. This maneuver keeps financial results as smooth as your grandmother's porcelain figures, though it's far from genuine. 9. The pension plan puzzlement. Pension plans, a dry and dusty corner of a company's finances, can become hidden troves of trickery. Schilit illustrates how assumptions about the future return of pension investments can be conjured up from a hope rather than reality. It's akin to betting your retirement on the belief that your pet rock will win the Kentucky Derby. optimistic, but hardly prudent. 10. The non-GAAP gimmicks. In a final flourish, our author cautions us on the over-reliance on non-GAAP, generally accepted accounting principles measures, which can be as non-standard as a unicorn at a horse race. Companies tout these customized metrics as a truer representation of performance, but they often exclude all manner of costs that a true knight of financial justice would deem necessary for understanding the real picture. Now, let's weave these insights together to paint you a grand tapestry of wisdom that would make even the most jaded auditor blush with pride. Earnings manipulation is the root of all financial evil, easing suspicion with a mischievous grin. As Schilit's lessons permeate your consciousness, you now know the tales of smooth earnings growth may be just that, tales. Much like an episode of your favorite soap opera, they might leave you gasping at the twist, but ultimately lead you nowhere. We have stepped, with cash flow in hand, into the land of operating cash that might better be described as manipulating cash. Beware the company that boasts a healthy flow of cash whilst quietly shedding assets, an act of desperation disguised as nonchalance. As we balance the scales, remember, a single glance at a balance sheet is akin to judging an iceberg by what's above the water. Dive deep, and you may discover that assets have been inflated to the brim and lurking debts conveniently swept under the lush carpet. When companies are throwing everything but the kitchen sink into their financial statements, you'll recognize this big bath as the setup for an all-too-convenient rebound. It's a clean slate, they claim, but in truth, it's more akin to erasing half the scoreboard during a lost game. Terrestrial sensation, or revenue recognition, has taught us to be present in the moment, for revenue is only as good as the moment it's truly earned. Do not be swayed by preemptive celebrations of sales not yet hatched, for such pronouncements of victory signpost a mirage rather than an oasis. Acquisitions, the growth maneuver often lauded by the press, can morph into a chameleon of concealed losses. Look beyond the handshake and the flashy press release. The devil's in the details, and those synergies might be more synthetic than synergetic. Behold the craft of capitalization. Beware the day when every expense becomes an investment, for that is the day you find your company owns not a solid fortress, but a castle built on shifting sands. As for reserves, remember the prudent cook keeps a jar for a true emergency, not one who eats the cookies when dinner is less than satisfactory, to pretend the feast was never disrupted. Pensions, those future commitments, can appear as solid as a granite promise or as flimsy as a political one. Investigate the assumptions, for there lies the rub between solvency and a future shock of retiree revolts. Finally, to the alchemists who convert GAAP into non-GAAP gold, we say fool's gold is still fool's gold, no matter how bright it shines. Insist on standards, for without them, we traverse a landscape with no maps, a sea with no North Star. In conclusion, Financial Shenanigans offers us not just a magnifying glass, but a searchlight on the darkest corners of corporate accounting. It implores us to question, to verify, to remain eternally skeptical of the numbers that businesses present. For in the treacherous waters of finance, it is the shrewd, the informed, and the watchful who navigate to the shores of truth. Be vigilant, dear investors, analysts, and students of the game, for in the end, it is your ship to steer clear of the siren's deceitful song. Remember, the next time you gaze upon a company's financial statements, you're not just an observer. You're a detective in a thrilling mystery where the stakes are as real as your hard-earned investments. Equip yourself with the lessons from Schilit and go forth to claim your rightful place among those who see beyond the veil of numbers and into the heart of economic reality. With this arsenal of insights, may your financial future be as bright as the truth you now have the power to uncover. Happy sleuthing.